Hi there. Welcome to our weekly live webinar event. Thanks for joining us. Just doing a little bit of intro, and we'll give everyone about a minute or so to join, and we'll start right on time. So I hope you are having a great start to the new year. There's lots of awesome webinar topics we've got coming up. Of course, this one being a little near and dear to a lot of people about taxes, because it does tend to be one of the larger expenses that many people don't necessarily think it's for them, right? It just seems as like money that goes away. It's not like for your house and you're going to have equity, or for your car and you own the car. And so everyone is trying to minimize. And of course, that's important. That's part of why we have a job as well. So we'll give everybody another minute or so, and then we're going to kick off into it. Welcome if you just joined. We're going to start right on time. Welcome, and thanks for joining us today. So another 30 seconds or so, and we'll hit it off. And let's see, just I guess I'll tell you, the next one we got coming up, it's actually going to be a really interesting one about us as a company and how we're different. And some of the cool things that we're doing and plan to do in the future. So if you can join us, it's going to be really good. If you missed last week's, it was on university plans, and the one before that, I think, is very important for everyone, was about concentration risk and practically how it pertains to a lot of people's investments, especially in their 401ks or TSP or whatever you invest in there. So we are right on the hour, so we're going to get started right on time. So let's go ahead and delve in. Let's get this presentation started here. Let me boot up my slide deck here. Right, hopefully you can see that now. So obviously we're going to talk about taxes, accelerating them. Seems like a very counterintuitive proposition, right? To pay taxes earlier than you have to. Sounds like a dumb idea, right? But these strategies and ideas could end up paying very large dividends for you. Of course, no one knows the future, but we're going to explore that and see why we say this and that it probably is a better bet. So, this is just a little intro. You'll find with a lot of my presentations, I love playing with the AI, and I made this picture actually for our last one when I told it to like make me doing a complex thing, and it's just a hilarious picture. So I had to throw it up again in another one of these slide decks. But we want to talk about some of these tax strategies and why there's a high probability that they'll be effective, and hopefully they will be able to benefit you as well. So our table of contents, which we're going to walk through, is, what is that traditional wisdom? You may feel it or have heard it yourself. Them rethinking that tax deferral concept, the pre-tax tax deferral as it is. Then think about longevity and how, over time we are living longer. There's a little bit of duplicity in that now in terms of have and have nots with longevity, but still on average living longer, and that has ramifications, especially to some of that traditional wisdom. Inflation considerations, we have almost been deprogrammed to worry about inflation until just recently, and so we're going to explore that. And was this high inflation period transitory and gone? Or is it something we need to worry about again? And then thinking about the deficit and how the debt and its increasing nature, what the impact of that might be in the future. And then, of course, really just kind of looking at strategies and what we could do. So that brings us right to the beginning of poll number one. We're going to throw that up. So I want to see what you think. When you're thinking about saving, whether it be your retirement plan or anything else, if you have the choice, would you rather take it pre-tax, get a tax deduction, pay the government later? Would you rather pay after tax, get it tax deferred, and then tax free if you wait all the way to retirement? That's Roth. After tax just means save it after tax and pay any taxes on anything that you earn, and you can use it whenever you want to. Now, of course, for different goals, that's different. But how do you feel about that? So we'll give it another couple seconds, let everyone roll in and figure out where the voting buttons are. Okay, so I think that's probably good enough. I think we got it. So it seems most people are voting for the Roth option. Roth option is one of my near and dear to heart. And so I kind of agree with you on that, but let's talk about why on some things. So I always like doing this. When I was in the military, this is something that I learned, and I always appreciated it when my commanders or whoever was presenting gave us the bluff, the bottom line up front. So instead of going through the whole book and then getting the summary at the end, what's the bottom line up front? When we think a lot about what I had talked about before, the traditional wisdom, and still a lot of people think this way, and who knows? I mean, you could be right. Nobody knows the future, but a lot of people just think taxes will be lower when I'm retired. And so that is why a lot of people just by default save pre-tax. They're like, let me take a tax deduction. It's right now. I'll defer it. I'm working hard. I'm making a lot of money. And then when I retire, I'll be making less money. I'll pay less taxes. But what I put here is like, will they? So I'm going to hit into that. And that is a big one that I think for a lot of people should be challenged. And CPAs, they have gotten into this, and even some of the younger ones, because they've been trained by some of the older ones, and I guess maybe how some of the accounting courses are, they're all about pre-tax, defer. I can't even tell you still how many clients we get where their accountant or CPA just straight up, oh, you can make this SEP contribution, you should do that. Now, of course, now you can make Roth SEP contributions. That did change. But until last year, you were not able to do that. It was always pre-tax. And so, again, kind of along the same lines. But again, this is kind of in your head. This is really respected professionals telling you to do the same thing, maybe for a little bit of different reasons, but still going down that same road. And inflation and longevity are going to be a big variable in this thing. And interestingly, we deal with this a lot as planners. People will come to us and they'll be like, I'm conservative, or I'm young, I can afford to take a lot of risk. And of course, there's personal preference in risk, not just time, but everybody makes the assumption that the only risk that they really have is the markets going up and down, how much money they're going to lose. But really, if you have a long time to invest and you need to live off the money for a long time, because hopefully, knock on wood, you're going to live a long time, then market up and down tends to be a low risk factor for you unless you panic and kind of screw yourself over. And inflation and longevity actually become far bigger threats, even though they're way in the future and seem a little amorphous. So let's just start out and look at a little bit of history here. And, we're kind of coming all the way up to modern where we are retirement plan savings wise, because, most of us that are not super wealthy are having most of our wealth either in your house in equity and or in your retirement plans, right? That you build up over time. So retirement plans generally going to be the money that you're going to use. House tends to just go from one house to another, unless you're, kind of lucky or outlier, where you build up a bunch of equity out in California and then retire to Montana or something like that. So 1930s and 40s, and see, we had high tax rates, upwards of 90% on the top, strong incentive to get any kind of tax deduction you can if you were making a decent amount of money and we're getting taxed not at the lowest rate. And I've got a chart that shows you what the income tax rates were and how they've changed over time. But obviously, very strong incentive once the income tax was created in the early 1900s to want to get that deduction and it deferred into the future. And that's a huge deduction, right? So then in the 50s and 60s, we started to have this introduction of 401ks, we call it defined contribution versus a defined benefit. Defined benefit were the old pension plans. And if you're still lucky to have one, you tend to be more of the exception now. But back here, defined benefit or pension plans from the company or from the state or whatever the case used to be the norm, right? So now we got defined contribution plans that are starting to take the place. And on top of that, then legislation gets passed to let you be able to do individual retirement accounts, which we're pretty much universally, everybody knows about them, and a lot of people that'll get their discretionary income up know they should be put into their Roth IRA if they're allowed to. It's a good idea to do. And in looking at that time period, I just wanted to kind of put a timestamp there. The average life expectancy was about 73. Of course, women living longer than men. And this was probably a little bit more uniform. If we skip forward to closer to today, life expectancy over 81 years doesn't seem that much longer. And still, the women live longer than the men. But there's more split on that. So it's a good bit more than back here. You have a good bit more people living over 90 to 95 than you did here, a lot more. And so, especially if you're a couple, you got to kind of have the expectation that one of the two of you is going to push 90, okay? Versus, back here, it's like you'd be lucky if one of the two of you hit 80 or over 80. And so that's a lot longer to live off of your savings, because if you were going to retire at 65 and kick the bucket sometime between, 70 to 80, you only really had to plan for, 10, if you were being conservative, 15 years, versus you retire at 60, 65 and live to 90, you're talking about 30 years. I mean, this is a huge difference in terms of how much that money's got to last for. Okay. And then, going through the 80s and 90s, good times for people generally. The middle class was still doing well and tax rates remained high. And so we got a lot more of this broad base with middle class and upper middle class wanting tax relief, pre-tax. It was probably a pretty good bet right here that traditional wisdom, because all of these things kind of stacking together created this traditional wisdom, and there were just a lot more people that fell into this category than of just pre-tax, take a tax deduction, defer to the future, retire, and then you're going to pay less taxes. Okay. And then when we're pushing into the 2000s where we are now, you majority defined contribution, 401k, rollovers to IRAs. And then, of course, in the pushing up through the 2000s, especially with the higher inflation now, the limits into those 401ks and stuff have just gotten pretty substantial. So there's a lot of money building up in these plans that you invest in yourself, or you pick the investments versus just putting in an application to get a guaranteed kind of check for the rest of your life, like Social Security or one of the public pensions. So now we're all caught up on that history. As I promised, looking at these tax rates, you got to see since we started it back here in the early 1900s, where we had to hike it for paying for the first war, coming back down, second war, and then it just stayed up, stayed up here until we started to bring it back down into the 60s. And then, of course, with the Reagan era tax cuts, brought it way down. And the lowest tax rate has been, pretty even, since World War II, with a little bit of breaks there. But still, you can kind of see that the tax rates have come down substantially pretty much since we've started them there. So I love stuff like this, the practical, like to use some case studies to look at it. So this just takes someone who's 35, and we're saying that they're going to retire at 65. All it did is saying they're going to put in $300 a month. Okay. And then if we do that, I even said, hey, the difference between pre-tax and saving Roth, that's what we're looking at here. The difference that you could invest more because you get a tax deduction goes into the account. So it's adding extra money to the pre-tax to make up for the fact that you get that deduction. You could save more because we want it to be apples to apples. That's what that means. And it's saying, let's say that we made an 8% rate of return. While you're working, you're paying 25% tax. And then while you're in retirement, you only pay 15% tax. So this is that traditional wisdom, right? You take the tax deduction now, you'll be in lower tax when you're in retirement. And because of longevity, living into the 80s, that tax Roth superpower is really, if you can get over a long period of time, that compounding rate of return. Because let's say, if you think about, like, say, the pre-tax account, then 70 or 25 to 15% of that whole account is the government's, right? And so when you're growing the money, it's great. You get to grow on the government's money. It is a very good thing. But over time, growing your own money to where none of it is the government's, that has a power of its own. So Roth tends to do better the longer you live as well. So it is a very good longevity hedge as well. So you can see, even with the fact that you can save more in the pre-tax and the taxes are lower, it's still pretty close. The pre-tax does win though. Okay. So this is showing the after tax. So even on the pre-tax, it's showing you how much you would have after you withdrew that kind of equally over the years in retirement and you paid your part to the government, what you actually netted out of each one. Okay. And so it does win, but marginally. Okay. Even with a 10% tax difference right there. Now, if we say, all right, let's do an even comparison here. So the same variables, except now we're saying 25% tax bracket while you're working and 25% tax bracket in retirement. Now, after tax, you can see there's about a 10% lean on the Roth. Okay. We're using that tax-free amount. This also skips that what I find with people that are retired is they do tend to withdraw a little by little, per year to supplement Social Security or their pension or whatever their kind of guaranteed income source is. But a lot of times they do use their defined contribution, IRA, Roth IRA, whatever, to take a lump sum withdrawals out of when things happen, whether they want to give to their kids or their grandkids or buy a second home or a vacation home or do a big renovation to make their house where their bedroom's in the first floor. Of course, you could take loans for that. But if you have lump sum events, then you can't count on just a steady tax rate. You may have bleeps where you jump higher because you have to take more out and you look richer if it's pre-tax. Okay. And so the Roth also protects you from that as well too, because if it's a tax-free account and you withdraw from it, it doesn't change your taxation. Of course, the politicians can change the tax code and blah, 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 and they have and probably will again. And we'll talk about that towards the end. So this is reverse wisdom comparison. And so again, all same variables up here, but now we're saying when you're saving pre-retirement, you're 25%. And when you're retired, the tax rate's actually 35%. So if you save very well, or they end up raising taxes to pay for, all the deficits that build up into bigger debts into the future. So under this scenario, you can see now we're starting to get even more substantial, pushing towards around 15 to 17%. You're better off in the Roth, saving the same amount of money. Just how did you save it? Did you save it where you pay the tax up front and then you get tax deferred and you get tax free? Or did you take a tax deduction, get the tax deferral, and then pay taxes when you take it out? So you can see kind of very marginal benefit, even with something that's pretty compelling right here versus pretty significant difference if the tax is reversed, that traditional wisdom is reversed. Okay, so let's keep driving on. And so longevity, as we talked about, and I gave you that example of like how it's changed over the last 30, 40 years or so. I mean, this is a huge thing. I think people now actually would like to, I don't know that many people believe it, but would like to retire earlier. I mean, I think most people, if they could retire at 50 to 55 or 60 even, would want to do that. Even though their life expectancy is not 75 to 80 now, it has a higher probability of being 85 to 95. Right. And so I know there's a knee-jerk reaction to that to say, well, I don't want to live that long. Have you seen, quality of life goes down too much? And I think that is one thing that you're starting to see improvement on, and is probably one of the next big medical things to come through, besides hopefully, knock on wood, more cancer progress, but is that's improvements to quality of life later in life, not just lengthening of life. So hopefully, we make improvements on, like Alzheimer's and other senior mental cognitive type diseases and deterioration. So, if that's the case, however long you live, if you're not just totally unhappy with life, the longer the better, right? If you get to see grandchildren and great grandchildren and you've still got all your faculties and you can get out there and do things, why not live longer, right? But again, that does cause problems financially because we have to fund that, right? And I don't think most people want to necessarily live longer just to work longer. And so then it becomes harder for that pot of money that you save to be able to not just support, like we thought about, in the 70s up into the 80s, to fund, a 15 or 20-year retirement. But now we've got to fund, a 30 to 40-year retirement, right? And so it becomes even more imperative. And things that will help us accentuate that compounding power of money, if we can grow it and invest it well, are going to have an accentuated effect, like the Roth savings. So I wanted to give you another example, and let me see, I did not anticipate that my video would cover this thing up. I wonder if let me see if I can move this thing real fast. Oh, I can turn my camera off for a second. All right, I'm gonna turn it off so you guys can see this whole thing. Okay, so this is just taking a scenario that we have built out in our financial planning software. And this view of it is giving you, in this part of it, the tax view. So when we will do a comprehensive plan for our clients, we'll program in all the variables from their life and how they're saving and what it's going to accumulate up to. And then we can look at it at all kinds of different perspectives. So this perspective is just looking at the taxes. So it's showing each year what the taxes are going to be. And so in this scenario, you can see after 2026, this client's going to retire, and they do have some after-tax savings. So like non-retirement, so like in their savings account, a joint investment account, say they were going to sell a rental property and have the equity from that they could live off of for a while. I'm just giving you different scenarios of how this could happen. So in their early years of retirement, when they're in their still early 60s here, mid 60s, if they're living off that and they don't have to withdraw from their retirement, their Social Security has not kicked in yet, they could theoretically almost be at zero taxes. And I know a lot of you probably paying a lot of taxes, working, and you're like, whew, that sounds terrific. And it would be for those years. But what ends up happening is you're creating a tax bomb. And there are a lot of people in this scenario that have taken that traditional wisdom, plus their employers save that way too, because the employers generally, they weren't even allowed to until recently, but the employer's not going to save Roth for you because they want a tax deduction. Right? So when they take their tax deduction to put the match in for you or to put a profit sharing or whatever the case, that automatically makes it pre-tax. So if you're putting in all pre-tax, the government's part is pre-tax. For most people, 85% of their Social Security will be pre-tax. Plus your employer put in pre-tax. You have a lot of big account and cash flow that's going to come that you still owe the government a cut on a progressive scale. And if you did that well, when your RMDs hit in, so that's required minimum distributions, and it forces money out of your pre-tax accounts, you can see there's this huge tax liability that's building up. Now, that's not a horrible problem to have. I mean, at least you have that money, right? And so this just kind of shows, low tax, and then we're going to jump up, 22 to 30% tax over time, okay? And so that's not horrible, but that is still given today's tax brackets, which we've talked about even for ourselves is historically low, and we just have rising debt. And compared to other developed nations, we're one of the lowest out there. Okay. So, I mean, this is probably pessimistic in terms of, or optimistic, in how little taxes will be paid if we as a society have to charge more to pay for things. Right. And that's a lot. Okay. And so, but still, if we put in, I wanted to make this apple to apple. So there were multiple other planning things we could put into there. It just kind of shows before and after. If we do all the planning stuff for people, but there's tax liabilities there, we still can accentuate their situation we usually take our plans all the way out to 100 because living longer is harder on your plan or more pessimistic. And so we want to make sure that we don't underestimate how long people are going to live. But still, their net worth at death would be about 1.3 million higher. So that's, almost 60% higher. That's rocking improvement. But let's look to see if someone just did some simple tax arbitrage and filled in these years to kind of smooth it out and then make it less for all the rest of the time. So as you can see, the top it ever gets to here is 150,000 versus crushing over that significantly earlier here for this. And again, prepaying taxes, just that the sound of that sounds horrible. The other name for that, that most people is Roth conversion, right? So you could see in this scenario, if this person, lives a long time, then that adds a whole other $1.5 million to theirs without changing their spending or anything. Now, in this scenario, it does take them probably about somewhere between 10 to 12 years to break even. And what that means is since they prepaid the taxes, that time value on money, it's worth versus the tax-free growth inside that Roth. But that's substantial. So anywhere past, kind of this point, they're ahead of the game all the way down the line. And that's going to give them more longevity treadway if they live to 120. It's going to be a lot more advantageous to have a bigger Roth account than pre-tax as well. So now that brings us to poll number 2. Let's go ahead and launch that. So this one is, I want to get your thoughts on inflation. Have we beat it? Is it just going to stabilize and keep going down a little bit till we get back to where we were? You think it's just, we'll stay about the same? We had it good and kind of lucky before, but, we kind of beat it, but it's not going to go back to where it was. Or do you think it will, rise back up and be higher? We could possibly even have a period like the 70s and 80s where we had a good bit higher inflation pushing into the teens. Okay, so we'll go ahead and end that poll. It looks like it was about even, but now we got a couple late votes in there, and it is swung over to the continue to rise. So that's pretty pessimistic. Who knows? It's very difficult to predict inflation and interest rates. When I was a younger advisor, I remember one of the things that stuck out to me was from a very senior fixed income bond manager telling me that interest rate predictions are harder and less predictable than a meteorologist telling you what the weather will be next month. So in that respect, kind of let that sink in. It's very difficult to predict. But let's look at some of the things. So why am I talking about inflation? Didn't we beat it? That's kind of the the message that's out there, I think, from both parties, and what's so to a certain extent trying to push that they beat inflation. The Fed did their job. The Fed is like, yes, we're going back down to 2%. But let's look at some of the things that are counter to that as variables. Not to say that it's counter that we know that it's going to change their future, but when we look at tariffs, and tariffs are in place now. They've started the first Trump administration, carried through on the Biden, and now probably going to go up some more. And tariffs generally will cause inflation because it causes prices to go up. Now, sometimes you can get some economic benefit if you can do them unilaterally. However, what ends up happening is they usually come back against you from the other side and snuff a lot of that potential benefit out. And so then you kind of get the negative just of the increased prices. And just a kind of an interesting, so you can kind of put a little bit of numbers to it that are practical, but tariffs are pretty inflationary. Just a 10% tariff for us, it caused 1% of inflation. And we're talking about doing that almost across the board with upwards of 30 to 50% on China. And that China is a lot of where we get our cheap stuff from. Right. And so, say it was an average of 20%. Now we're going to have inflation normally. Inflation is healthy. We want to have that some. So if we got 2% just on top of our normal, and our normal, one might argue is around 3 to 3.5. If we look at like a 40 or 50 year period, not just the last 10 to 20 years, then you're easily looking at, 5 to 6.5%. Right. Which is like 3% higher than right now, right? Just from this one variable. Okay. Another thing, it's very popular right now that across the world, not just U.S., across the world, there is a lot of anti-immigration xenophobia, and wanting to deport people and what's so. And in our country, we rely a lot on our immigrant workforce to do a lot of the jobs that we don't want to do. And sometimes we don't have the labor participation to be able to do it. And so if this really turns into action, um, and that those promises are followed through with, then this is really going to push inflation, because two of the main things that will increase inflation are what the cost of things are, so like commodity prices and how much we have to pay, and if there's some friction like tariffs slowing it down. But then the other half of it is just wages. The more wages go up, the more you're going to see inflation goes up. It tends to be almost 50% of inflation. And if some of our immigrants are doing a lot of the work that are on the lower side of the wage scale, and to get anybody to do it, we have to pay a lot more, and we still may not be able to fill all that. This could be a very powerful inflationary pressure. So I think there's a lot of impetus from people to want this to happen, for like emotional reasons. But I think a lot of those same people are going to be the ones that are hardest hit from increased costs if it actually goes through. So these two things are probably going to be the hardest thing. But even beyond that, I think most of us in the country, besides the people that own all the big companies and CEOs and the managers that get paid based on how profitable their businesses are, want to see more wages increase and Americans to have higher. And if that's just the same thing as this, though, if wages go up, we're going to have more inflation. Okay. So hopefully the average American's wages goes up more than inflation, so it doesn't hit, but it will rob a lot of the progress that they hope to get out of the increased wages. So geopolitical tensions and commodity prices, I already started to hit on that when I was kind of feeding back to this. So if prices for things go up, we're going to have to pay more for the finished product of those things. And of course, the price of things are where inflation comes from. And of course, the more wars and tensions and tariffs and all the things that are going on geopolitically, then that just makes those things even more expensive. Generally, our debt is inflationary as well. We've hit past $35 trillion. I mean, it's so many zeros. That's so big a number. It doesn't even really like register in most Americans' brains how much we owe and what our part of it is. And over the next 10 years, we're expected to hit $10 trillion more on top of that. That's without anything bad happening. If there's some other big 2008 type event, or coronavirus type thing where the government wants to help bail out, that would pump it up more. This is just with everything that's going on without anything bad happening. So that's huge. Expansionary monetary policy. So what we mean by that, we've seen multiple governments try that, most recently Turkey, where they're like, we don't like low interest or high interest rates. And so if you start having inflation, and let's say the administration pressures the Fed not to raise interest rates to try to stop that, right? Because that is one of the main tools that we have to be able to stop that, and say, no, we're having low interest rates. It's what we believe in. We're keeping this environment good for growth. You really can let inflation run away. And that is what happened in the 70s. And then eventually we had to come in with the Volcker, and they just slammed interest rates hard. And if you were there, or your parents, can remind you of having a 15 or 17% mortgage back then, and what that truth in lending statement looked like. And of course, if you are foreign born and have experienced some of the hyperinflation in countries outside the United States, you absolutely know how bad this can be. So just kind of FY about this. I'm not trying to paint a horrible thing, but people just need to understand that we have to balance out things. We just can't do things because of how we feel about them and not consider the consequences. And then beyond that, you personal planning wise, how you're going to organize things. I think one of the smartest things you can do is to situate your financial situations to protect yourself from inflation in the future. Because even if it doesn't happen, the impact of preparing for it is so small if it doesn't, versus if you don't prepare for it and you unfortunately pick things that are weak to inflation, you could be hurt significantly or handicapped. So let's do another poll. So we're going to be done beating up on inflation, kick over to taxes. Where do you think taxes are going? You think we're going to have higher taxes in the future? You think they're going to go lower? You think they'll stay about the same? And we're talking, you know, I would say 10 to 20 years in the future, not in the next 2 years or so. Because I would say in the next 2 to 4 years, you're going to see lower taxes, primarily from corporate tax rates going down. But still, I want to know what you think, because this is something that I think is pretty polarized. But I'd say more than not, when I've talked to lots of groups and what so people think taxes are going higher, just because it doesn't matter what party you're in, you know that we're running up the debt. And I think we as a people eventually will pay what we owe one way or another. Okay, so it looks like this one's split pretty even. It's about, down the middle between higher and lower, stay the same. So that is, probably pretty typical. Everybody's got different views on it. I would say it's probably, again, like I mentioned with inflation, safer for you to prepare for higher taxes. And then if they don't materialize, you're just going to have more than what you thought you needed, which is not necessarily a bad problem to have. So here's a look at how our debt has kind of ballooned over the last 20 years and who holds it, right? And so you could see that kind of $35 trillion number right here as of, this is as of August, ballooning up. And interestingly, though, almost 75% of our debt is held by ourselves, either by our own government or our financial institutions and other institutions and wealthy individuals and what so hold almost 75% of our debt. And then all other countries about 74, or I mean 24%. And nobody is over Japan. Nobody's really over 3% except for Japan. So that's, this catches people off guard because I think they think China owns a lot of our debt. Now, of course, 0.1 trillion is a lot of money, right? But still, or 0.8, it's less than people think in terms of that. So we hold a lot of our own debt, and so still, the piper is going to have to be paid one way or another, or debt cancellation, or higher taxes, or inflate our way out of it. Hopefully, grow and productivity way are out of it. But that takes a long time, and we are not slowing down, as you can see here. So thinking about the impacts of that, we obviously are having a growing national debt. So, just, 2 to 3 years ago, we were at 31 trillion, and now at 35. And then, of course, the more interest rates are higher, the more of what we make or collect is going to go towards debt repayment and more towards the interest, not just getting it down if we were even paying that much, right? And that's going to leave less for these unless we run the debt up even more and exacerbate the problem. Strategies, I think I already talked about these a little bit. You and businesses, there are lots of strategies that we'll explore some of them to help you mitigate that and hopefully protect against future taxes. I'm going to talk about what some of those future taxes could be that don't necessarily exist today. And so nobody knows exactly how future politicians will solve the problem. So that is a little bit of the conundrum of that as well. Of course, intergenerational equity, if we keep running up the debt, eventually somebody's got to pay the piper, and it could be unfair to our kids, or if you're young enough, to us as well. And then, of course, impact on economic growth. If you leverage up and interest rates are low, then you get a great now boom. But then in the future, when that interest and everything slows you down, kind of like you try to run forward with a parachute behind you, pulling you backwards. And then is it going to be sustainable? And at what point does it not become? So this just kind of shows you, I talked about corporate tax rates. and you can kind of see how they've changed versus how we looked at the top rate for individuals, and the average tax rate was probably down right around here. So for the majority between the 40s to the end of the 80s, corporate tax rates were probably maybe a little above or on par with average individual tax rate. And then after that, the corporate's gone below, now a lot below, and it'll probably go down to 15%. So you're kind of seeing that. The trend is that more than likely corporate taxes are not going to solve this problem, especially in the way that they're trending now. Obviously make the rich people pay. And how that's been trending, this is just shown the last 25 years or so, is that you could see the tax rate on the estate tax. This is like how much can you give to your heirs tax free. So let's say back in early 2000s, it was around 1 to 2 million. That's jumped all the way up now to dang near pushing towards 14 million tax free, and the rate has gone down about from 55% down to 40%. So pretty big discount and how much more you're allowed to give. So the way that we're trending in how we're doing things is we don't really seem to have the will, or our politicians aren't like affecting that well, to tax the top, to be able to help with that either. There are actually more and more tax breaks to corporations and to wealthy individuals. And of course, most people, how many people do you know that have more than $14 million, right? So this is not people most of okay? All right, so potential long-term tax changes. So of course we have capital gains. So capital gains are when you make money on non-retirement type stuff, like you own some Coinbase or Nvidia. Hopefully, if you own some of that, you got a good pop off of that, and then you sell it. Whatever that gain is, you're going to pay taxes on, and then it goes 0, 15, or up to about 20. Okay, so pretty much 15% tax is the capital gains rate on that. And then, of course, the one that most people know and pay, the income tax. So on what you earn. And then we have the estate tax, or as it's gotten kind of whitewashed over time, the death tax. So when you die, past the amount that you're allowed to pass tax free, then there's a tax on that. Sales taxes, most of us see that on if you have it in your state. But other countries like Europe and so have a VAT or a national sales tax. That could be a future potential thing. This one tends to be regressive because generally the lower the income, the more you have to spend of what you have or make to be able to live, versus wealthier people save more and this tax doesn't hit them. Then you have a wealth tax, which is on the opposite end of the spectrum, hits people that are wealthier and says, all right, each year you owe 2% of whatever you have. And there's usually some kind of exemption, to say, if you have less than $5 million, you don't have to pay this. That would go the opposite way of you've seen the estate taxes go down over time. You see, like Bill Gates' proposal was to take to levy taxes on robots or automation that takes human jobs. And that is one of the things that when you think about this, I think the initial knee-jerk assumption is it's just going to be higher taxes the way that they are now, maybe a little bit higher capital tax gains rate, and then higher income taxes. And you know what? The people do tend to do things that they're familiar with and that they've always done. And I imagine there will be some of that, especially in the shorter term. But if you do see more of artificial intelligence and robots that are doing more automation type jobs like they've already done for a couple decades in like car manufacturing and then you're going to see less income, right? Because less people are going to have those good jobs that are taken away. And so this could happen. This could be a good solution. Americans generally don't like this because it seems too socialistic. But it is elegant for when there's huge wealth inequality. This works as well too. It's kind of like this, but let's just wait until you're dead, right? And then of course, I imagine when they really do something, over time, it's going to be a combination of all these things. So Really, I do this just to challenge people's paradigms because I think they only think about this. And I do think in the next 20 years, it's primarily going to be raises in this after the initial kind of 2 to 4 year cut now. But who knows? Nobody knows this for sure. And so then that's what we start talking about acceleration of taxes and what so, which is the title of this presentation. So what do you do? What are some strategies? And so the conventional wisdom is not thrown out the window. And if you are at the top of the tax bracket, paying 30 some percent federal plus, 8 to 15% state, that's pretty high. It's pre-tax is still probably pretty good for you, right? It's still a pretty good bet, depending on how much you have. You have to do analysis on what's out. But when we look at, taking advantage of the pre-tax, there are, I put over here, when you look at it, tax loss harvesting, tax aware investing. So what that means is recognizing losses faster to knock out some of your gains, or to even be able to deduct $3,000 a year against your taxes. But again, all you're doing is pushing that into the future. If right now your capital gains are 15%, and in 10 years from now, the capital gains rate's normal income, which for you is 45, you did not save anything by not raising your cost basis when you could have paid 15%. Okay. But if you have a lot of gains and you have some things that you can sell to offset some of that, you should still do it. And if you want to pay more and you have a lot of pre-tax, then that's where you offset some of that with the Roth conversions, and get some of that normal income into a tax-free account. Okay. And so tax-aware investing, the tax loss harvesting, absolutely tools that should be employed strategically, not just blindly because deferring taxes is superior. For some people, it still may be strategically in small things. Even if you would be better at accelerating taxes, you can still do that and accelerate, your Roth conversions or something. And then if you are any kind of charitably inclined or what so, then in your non-qualified or your non-retirement stuff that has big gains, you can give some of the highest appreciated stuff away and raise your cost basis that way. You can also strategically harvest gains if you have a year where you have more losses or a lower tax year for you for some other purpose, like you started a business and you were in a high-paying job before. That could be a good time to do it as well. Strategies just in financial planning in general. So we talked about the acceleration of taxes. Two of the most obvious are the Roth conversions and the capital gains. But also, if you're any kind of charitably inclined, there are all kinds of things you can do, and marrying multiple of these things together with that, you have to be very strategic about it and not just do it at a whim, right? This comes from our webinar 2 weeks, or maybe it was like 3 weeks ago, where we talked about the concentration risk. People need to be really careful about what you're keeping inside your portfolios, because you could be concentrating, putting all your eggs in one basket or very few and not even realizing it. So go back and watch that if that's something that you're interested in. I would be careful with leverage, especially variable interest, because again, we don't know what's going to happen with interest rates. But I think the assumption is, you can see it right now with people not taking out mortgages or buying as much because they're waiting for the mortgage interest rates to go back down. They may not. They could go back up. And if you're on the riskier side or want to start a business and you're like, oh, I'll just take this SBA loan, it's 10%, but it's variable, it'll go down to 7 or 8. I can carry that even if I'm only halfway successful. Well, what happens if it goes up to 15%? Because you're locked into something that's tied to LIBOR or something and interest rates go up? It could sink your whole business. So you got to be careful with this. If you do use interest and it's worth it, you still have the ability, if you had the ability to pay it off if interest rates went against you, obviously. But you got to think about it a lot more and not just make these assumptions that we're going back to low interest. I really hope that we do. I really do. But I would be careful about it. And then if you're farther along in your life and you have a successful business, look at some of the other things that you can do in terms of ESOPs and employee ownership trusts and what's so beyond just selling to private equity. There are tax benefits to these things. You can spread out wealth and still have an awesome, kind of cash out event for yourself as well too. So find someone that can help you with that. And then when we're talking about a lot of these things, there's lots of other planning things, but I'm trying to keep within the theme of this webinar. You need to model these things out. If you are here thinking about these things because you have a lot of these things, your life is incredibly complex with the amount of variables there are, the amount of time there is, the compounding of your rate of return, of interest, inflation, all these different things. Even if it doesn't seem like it's that big, can make you have wildly different outcomes than you might expect when you combine multiple of these strategies together, and you need to model them out to see what the different permutations would actually do and what's actually the best for you. Okay. So that being said, this is kind of my plug before I open it up for a few questions. If you ask me a question that I don't get to, I will follow up with you with the email response as well. So check out our website. It's rebelfinancial.com. We have a lot of great information up there. We try to be very transparent. Had that from most of our clients that have joined us that really did their due diligence. They're like, man, it was nice. It was refreshing to come in and know exactly how much you charged. And most of my questions were answered. I just really wanted to see if I liked you guys before I hired you. I already kind of knew the answers to a lot of my questions, but we do a lot of the traditional stuff that most firms do, which you think investment and retirement, investment management, retirement planning, estate planning, charitable, special needs planning as well. But we also do expanded wealth management. So we're a wealth management firm. We call it net worth versus just an investment manager or a financial planner. So we help our clients make sure they get the most out of their FDIC savings. We help them plan like their loans and liability and paying things down, or when they should leverage or not. Tax planning, a lot of our clients do their taxes through us. We also have a couple CPA partners as well too. We do a lot of modeling in the future, not just preparing for what happened in the past, which is different than a lot of CPA firms. Then we do a lot of other things too, like business services. So business planning, business consulting and coaching, bookkeeping, payroll, with some of the benefits design and 401k and pension plans. Beyond service-wise, we're very different. We're multiple custodial. So I think we're the only RIA in the country that has over 10 custodians. So we don't just work with just Schwab or just Fidelity. We do work with them, but we also work with TIAA and Interactive Brokers and Vanguard and Axos and Altruist, a bunch of others, a couple crypto custodians. We're one of the few RIAs in the countries that does do digital assets and crypto. And so we're fee only. We don't take commissions. We're always a fiduciary to our clients. You can read through a lot of these things. We're super tech forward. You don't have to use our tech and be tech forward, but we do it for you. It does help us reduce costs and give a lot more service than we would be able to for being able to drive down costs. We're a B Corp, so we're still for profit, but about as close as you can get to being a nonprofit when we're still for profit. And then you can see a lot of the things that we're doing. A lot of this stuff I'm going to dig into deeper in the next webinar if you're interested. So this is our team. So all the people that work for all of our clients and us trying to do all those things. You can schedule an appointment with that QR code. This is the same one. So we'll open it up to questions. So let me go over there, pop it in. If you haven't already, if you have, let me find, there we go. Right. So, all right. So would my heirs benefit more from inheriting pre-tax Roth or after-tax account? So when we think about that, generally, again, things could change. But as it is right now, the most beneficial thing to inherit is going to be Roth, okay? And with the Roth, they're going to get that. And then generally, there's a couple nuances to things, but generally, they're going to have 10 years to keep the tax-free deferral for an additional 10 years after they inherit it. So they're going to get it tax-free, and they're going to get an additional 10 years to earn more interest on it and get it tax-free. If it's after tax, the way that the law is now, they get a step up. So if there's a lot of capital gains in it, they'll get a step up in that cost basis. So they shouldn't have to pay taxes on it unless they're going to hit over that, almost 14 million that we were talking about. And they get out estate tax free. But then after they get it, they're just going to pay tax on whatever they earn at their tax brackets, et cetera. If it's pre-tax, they got to pay all the taxes at their normal income tax rate. Plus, you got to pay whatever your RMD for the year that you died was as well on the taxes. So, Roth and after tax by far better than pre-tax, and then the Roth marginally better than the after tax. The other thing I would say, though, there's been multiple proposals to like get rid of like the estate tax. Again, I think that's why they labeled it that negative death tax thing too. But one of the things that almost goes hand in hand with that would probably happen, which would be that the people would lose the step up in cost basis, which is a boon to middle class. And so you'd be given a toss out to really rich people and taking away a really awesome benefit from middle class and upper middle class. So I caution people for them when they support getting rid of the estate tax unless they're super wealthy, because you could be shooting yourself in the foot. Now, if that ends up happening, then Roth would by far be better than the after tax. So I like for people to understand that as well. Next question. Could a Roth conversion ever be beneficial if it puts you into IRMA? So IRMA is I guess almost like an extra tax that you have to pay on your Medicare premiums if you make over a certain amount of money. So why don't we pull that up here just so you can see just what that is, what this person's asking right here. And so here you can kind of see, if you make less than 206,000 AGI and you're married, then you don't have this. Actually, let me see. But you can see if you make more than that, then you're going to go up to 244 from 174. Okay. And then you're going to pay a little bit extra for your Part D if you have that in your Medigap. But you can see how much it goes up. The more you make, the more you pay. Okay. And so that's what that person's asking right there. That's what that IRMA is. A lot of people aren't even aware that exists because we don't pay quite enough for a Medicare to pay for it. It still is kind of progressive. So if you're wealthier, then you're expected to pay more on your premiums, right? But just like I showed you in that one chart where those RMDs go up later in life, people that have saved real well, we found, and we're not a high net worth firm. I mean, just upper middle class. If you saved well in your 401k and you didn't have a pension and that built up and you invested it well, a lot of those people are going to hit IRMA pretty significantly and then be in it for the rest of their life. As those RMDs keep coming out. So a Roth conversion, if it's enough, depending on if you do it over enough years or you do a big enough one, can absolutely realize those taxes faster and then make the taxes less for the whole rest of your life. So it could significantly reduce IRMA from that kind of tax planning perspective. And so it could be a great strategy beyond just the longevity and the tax arbitrage side of things, as we illustrated inside there. So great question. Let's see if there's any more questions. All right, looks like not. If you have any, you think of them after the fact, go ahead and send them over to us at support@rebelfinancial.com. I'll answer them for you. If you're watching this as an on-demand webinar, you can absolutely ask them in the app. It'll forward on to you, and I will get them answered for you. So next week, we're going to have the next webinar is going to be Why Choose Rebel Financial, an inside look at our mission and values. I know that sounds kind of corporate-y and boring, but I want to very well tell you it's not. It's going to be a great presentation. I've already got about 3/4 of it done, and I'm actually pleasantly surprised in terms of how interesting it is and how I'm digging into how we've built and are building some of the new things that are coming out. You'll like it. Then the one after that, well, actually, we got to skip a week because I'll be in South America. But we're going to do one about our business services and how, if you leverage those, how much it can really save you. So if you're interested in that, that's going to be a great one. If you know somebody that owns a business, have them sign up and check that one out as well. So appreciate you taking the time to spend a little bit with us today. Hopefully it was worthwhile It has challenged some of your preconceptions about things in a very good way. That's going to help you plan better, be safer, make more, and have a higher probability of success. If there's anything we can do to help you, would love to be able to do it. Like I said, scan this QR code, meet with one of our advisors. We'd be happy to help you. And then if you saw that it's a good synergy as a team, be very happy to be able to be of service to you as well too. So thanks so much. Happy New Year. And hopefully we will talk to you soon. Bye-bye.